Hello, chart watchers, and welcome to this Thursday, May 23rd, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the sellers are back today. You can see the Dow Jones Industrial Average currently near its low of the day, down 396 points. The S&P 500 down 43, challenging the low that we saw about 10 days ago. The NASDAQ actually breaking below that low, currently down 139 points. Russell 2000 continues to perform poorly on a relative basis, down 29 points back near the 1500 level where we actually bottomed in late March. The 10-year Treasury yield, this is a big news story here, breaking down below the double bottom at 2.36%. It is down almost 8 basis points to 2.32%. Volatility index, as you might expect, back on the rise, nowhere near where we saw 10 days ago, but currently rising. We'll want to watch that this afternoon. Energy, the weakest area of the market, falling apart here, down 3.6%. Technology also having a rough day. You can see a couple of the industry groups here in the energy space breaking down to at least the last couple month lows. Semiconductors, one of the big culprits in the technology space. And then moving our attention to earnings, Medtronic and L Brands both came out with decent results, gapped higher. Both are up so far today. Network Appliance, not so fortunate. They did miss top and bottom line. Not a great forecast. The stock getting hit pretty hard. And then finally, Chipotle. This was a big surprise to me. This is a stock that's been outperforming for a while, but there are concerns growing now over the African swine fever. Rising pork prices caused the downgrade in Chipotle, and you can see the stock really getting hit. Now, I'll be interested to see whether or not this one recovers by the end of the day, but right now this is a definite breakdown on the chart on Chipotle, and this has been one of the better stocks in the market. So not great stuff happening today. Erin, how are you doing?
I'm doing quite well. I'm seeing rain. It's Southern California. I'm not supposed to see rain, and I've been getting rain a lot lately.
Yeah, you're seeing rain and I'm seeing red.
Yeah. Yeah, but I'm not going to talk about that.
Yeah, we'll just, if we ignore it, maybe it'll go away. Is that what you're saying? It's kind of like the rain.
Exactly. There's always a little green in the account. You never know.
That's all right. We got our very own sunshine here today. We got Julius de Kempenaer with us. Always fun to have Julius on. Julius, how are you doing today?
I'm good, Tom. I'm glad to be back from sunny Amsterdam for a change. I mean, we've been having some bad weather, but it's turning better now, so that makes me happy.
Well, that's kind of what's been going on here in the U.S. I know Erin was complaining about her weather a couple months ago. Couldn't get above, 100 degrees, Erin?
Yeah.
Kidding. 70 degrees. I think it was 70 degrees. Didn't you have some kind of a record where
February in Southern California, LA, we never reached 70 degrees, and it was like the first time in I don't even know how many years. It was very strange spring, and spring is still here. We've yet to experience really summer at all, and that is very strange.
Well, hey, at least you're breaking some records in some areas if it's not in the stock market.
Well, there you go.
Yeah. And I'm sure we got a lot of folks listening in from the Northeast U.S. or from Canada that really feeling bad for your February temps, only at 65 degrees or something like that, right?
Yeah, I know. It's
all relative, just like the market.
Yes, but we pay for it in other ways living here.
Well, Julius, I do want to welcome you back to the show. I know you got a great segment for everybody. Everybody always enjoys your segments and your look at the RRG charts. Of course, you founded those. So if you'll stick around with us, we're going to bring you back about 15, and I know you have a great presentation for everyone.
Absolutely. I'll be here all the time.
All right. Yeah, he's going to stick around. Julius always sticks around with us till the end of the show, too, which makes it a lot of fun. But Erin, why don't you go ahead and get us started?
All right. Just the big reminder is Monday, there is no Market Watchers Live because the stock market is closed. Tuesday, I'll be doing a workshop. I might probably rehash the PMO a little bit and look at some other momentum indicators. Larry Williams will be with us on Wednesday, and then Dan Russo from Chicken Analytics will be with us on Thursday. Today, after our technical news and headlines, our first segment, of course, is with Julius, and he's going to be breaking it down with RRG, we'll have to see how that goes. I think it'll be very interesting right now. 10 and 10, Halliburton will be our first symbol, HAL, H-A-L. And then we're going to finish with a new segment we're calling the Dead Zone. So stay tuned for that. And as Tom said, Julius will be joining us. Okay, news and headlines. What's going on out there, Tom?
All right. Well, I mean, the economic reports that came out weren't horrible. I don't think that's what's driving the market lower. But we had the initial jobless claims came in this morning at 8:30 Eastern. They were 211,000. The market was expecting 215,000, so better than expected there. May PMI composite flash did come in a little bit below expectations. And then finally at 10 a.m. this morning, April new home sales came out. They were just slightly below expectations. But again, nothing horrible there. As far as the reaction in the bond market goes, though, this is not good. And again, looking at it, it's hard to argue with what's going on technically. I know Erin and I talked yesterday about the fact that the TLT, which is the longer term treasury bond, thought that was going to go higher, which obviously means yields go lower. That's just the way the charts have been setting up. I mean, we've been in this downtrend here on the 10-year treasury yield now since back in the fourth quarter, early in the fourth quarter of 2018. And it looks like we're getting another breakdown in the yield. And there's two different ways to look at it. The bullish equity view would be that, hey, we're getting this breakdown, but it's not because of weak economic outlook. It's more because of a deflationary concern with the dollar strong, commodity prices down, crude oil's dropping. We don't have an inflation problem, Fed. We have a potential deflation problem, and you should be cutting rates. That's the bullish argument for the U.S. stock market. The bearish argument is that, no, this China trade war is going to eat into the economic growth. That 3.2% GDP we just saw was a mirage. Things are going to go much lower later in the year. You can take it whichever way you want. And to be honest, I'm not quite sure which way to take it at this point. But so far, the U.S. continues to outperform some of the other areas around the world. And so that, to me, tells me that our economy is still stronger and that really what we need is a rate cut. But, we'll see. As far as earnings that came out last night, this morning, we had C-Trip, Synopsys, Network Appliance all came out after the close last night. Network Appliance, that was just not a good report. But I will say that we should have been expecting it given the way the stock has been trading. C-Trip and Synopsys both reacting pretty well today, though, and moving higher. Medtronic then this morning came out. They did beat on their bottom line, as you can see, and a couple of banks coming out, Royal Bank of Canada and Toronto Dominion, both with better than expected results. After the bell tonight, still got some pretty big names coming out into it. It was a huge report they had last quarter. We'll see whether or not they can top that one. And then you can see a couple of other headline names as well in that space. All right, let's take a look at Network Appliance. Yeah, this was just not particularly good here. You can see the gap down today with the very heavy volume, already 7.8 million shares. Looks like it's going to be the heaviest volume day of the year. Maybe we close back at the high and leave this long tail to the downside, which could be a good short-term signal. Maybe we get a rally off of this. But overall, I'm not liking the way this chart's been looking. Network Appliance with today's gap down now looking at a 52-week relative low versus computer hardware stocks, their peer group. And you can see computer hardware really getting hit hard. This is one of the areas of the market that's getting hit hard as a result of what we have been seeing in terms of the trade war. If you take a look back at the fourth quarter last year, this group really got hit versus the S&P 500, and it seems to be starting again. So there's no doubt that there's a lot of implications here for computer hardware. A lot of these companies do business in China, have manufacturing in China. There's a lot of connections there that are making it very difficult for the group. So when we get into the dead zone at the end of the show, we're actually going to look at it a little bit on the RRG, some of the areas that have just been dead during this period where we get into the trade war talks, a lot of fear building and so forth. Computer hardware, one of the groups we'll take a look at later in the show. But Network Appliance here to me just does not look very good. I like the fact it's trying to recover off the earlier low, but it's still down 10.5%. And this is coming off the heels of already a pretty steep drop. Stock was down more than $10 in the month heading into its earnings report. Now it's down another 7. Not very good here on network appliance. MDT, Medtronic. Taking a look at this one, a lot of sideways consolidation here. Of course, this is in the healthcare area. Medical equipment, I think on a relative basis after moving higher. Right now, we have a little bit of a symmetrical triangle. We've got lower relative highs, higher relative lows, waiting to see which way this breaks out because Medtronic is actually starting to perform pretty well relative to the group. So if the group could start to gain some momentum to the upside again, and on a relative basis, we have seen a little bit of relative strength. If we continue this and Medtronic's starting to show some leadership, breaking out above prior highs, I think this is a stock that certainly could go higher. Initial target would be up around 93.5, 94 to challenge the February, March highs. Okay, how about Synopsys, SNPS? This one is in the software space. Of course, a lot of software stocks have been getting a lift. This is a great area of the market. Even with the recent weakness, software not getting hit nearly as hard as semiconductors and computer hardware amongst those technology peers. So software continues to hold up pretty well. And the best way to visualize that is just simply looking at the software relative to the S&P 500. I'm sure Julius could show you the same thing if we looked at industry groups versus the S&P 500 on an RRG chart. Software would be over in that leading quadrant. It's been a great group, and unfortunately, Synopsys, even though it did beat top line, beat bottom line, it has come up a lot off the bottom. The stock was up more than 50% just about a week ago. And so I think it's just consolidating. I think this still remains a very solid stock. You can see on a relative basis, it's still holding its own in a very strong group. So I just think outside of maybe some consolidation, I would expect down the road that we'll see another breakout in SNPS, especially if software continues to be among the relative leaders. C-Trip beat on the top line, beat on the bottom line, actually is well off its earlier low, and it is trying to hold on to gap support. I was thinking this one had gapped earlier to the upside, but it actually did gap down, still down 4%, but it is well off its earlier low. This is an area where if it didn't hold this gap support, and maybe even today's intraday low, which was 34.87, I would not take any further chances here. This is a stock in the travel tourism space, which is near a 52-week relative low. And you can see the stock relative to its peers is starting to downtrend, has been now for about 6-7 weeks. So combination there tells me I want to make sure I keep my stop really tight if I am in this stock. So if you're counting on that gap support to hold, I would probably be looking at today's intraday low as an area to watch closely. The last one I'll bring up, then we'll go over into the upgrades, downgrades. L Brands. This is in the apparel retail group. I wrote about this group in my blog this morning. We will also talk about this group a little bit later in the Dead Zone segment. But this group has been horrible. As you can see, it has been moving lower for the last 30 days. But look at the relative strength, or in this case, relative weakness of apparel retailers versus the S&P 500. This is a group you definitely want to avoid. LB has actually been one of the worst performers in the group. I think it's getting a temporary boost to the upside personally. I think that the overhead resistance at about 24.25 is going to be difficult. We had a number of bottoms come in closer to 25. We've got the 50-day moving average. A lot of technical barriers that LB is going to have to negotiate as we go forward. In the way the group's performing right now, I think that's going to be a very difficult task. LB did beat top line, beat bottom line. They guided Q2 earnings per share lower, but then they raised the low end of their fiscal year 20 EPS. So a little bit of a mixed bag there, but clearly by their report, I think you can see why the company was trading so poorly. They did struggle in terms of their forecast going forward in the next quarter. Okay, Erin, upgrades, downgrades, and then we'll get on to Julius. What you got?
All right. I've got 3 upgrades, 3 downgrades for everyone. We're going to start with the upgrades. Amgen was upgraded today by Citigroup from a neutral to a buy. You know, it's bounced, it's managed to set a bottom, a low for the year so far. I wanted to look at a weekly just quickly because, again, anytime I don't see the support levels on the daily chart, I want to look at where they are on the weekly chart or the monthly chart if you have to. Looks like the next area, it could certainly continue lower here. It could go down to that 160 level as the next area of support. But I have to say, I think that the daily chart isn't looking too bad here. We have an oversold PMO. It's just now giving us a buy signal. You can see that rising bottoms are happening here on the OBV. We're getting a little bit of improvement here on the scooter. The only thing I'd be really watching is if we are going to be able to see Amgen get above overhead resistance at the low back here from December. I think if you wanted to go in, let's go ahead and go in there. I'll show you what I mean. If you wanted to look at more of a short-term area of overhead resistance, so let's skinny that one up. We can go back here to that low we had back in April and notice that we're sitting right on that area of overhead resistance. So I think with the buy signal, and if we can get it to pop above that short-term low, you can see it's already managed to get above the declining tops trend line. So it is trying to break out of an intermediate term, intermediate term downtrend. So I'd be watching that overhead resistance. I think this is very promising for Amgen, but it is a biotech and they do tend to be, rather bouncy, volatile. So that's just something to keep in mind. Philip Morris was upgraded today by Barclays. This, of course, is in the consumer staples area. It was upgraded from underweight to equal weight. So they're moving into a neutral position. Their original target was $67, which of course is way down here. And they have moved it up to 82. So I know that can sometimes be confusing, right? You're getting the upgrade, but the price that their target they're giving you is below the current price. Well, like I said, we're moving into an equal weight or a neutral position. So it looks like we're in this area of this trading range, and I would suspect that's what Barclays is seeing. So they're suspecting it to go down here and test the bottom of this range, and then possibly we could look for it to go back up if we're going to just stay in a trading range. I would expect that. These consumer staples, we do talk about how they aren't necessarily the sexiest stocks out there, but in a downturn, they're probably where you want to be. So it's just something to consider. I have the PMO buy signal, but I think this one is going to probably go down and test that the bottom of that trading range before we see it move to the upside. Atlassian. Team, TEAM. This one was upgraded by Morgan Stanley today from an underweight to an equal weight. Similar situation to Philip Morris. No targets were given. I did look at this chart. I've got a PMO rising, and it's certainly not what I would say extremely overbought. It's getting overbought. I would look at the +6 to -6 possibly as the normal range. You've got to look at the OBV. It's really confirming, price moved up and we're seeing the volume right there with it. And a lot of times you'll end up with a reverse divergence. You'll have the volume coming up here, but then price just doesn't manage to get higher than the previous tops. And that I find to be worrisome, because if the volume's coming in and you still can't get the price movement, there's a problem. I did annotate a possible flagpole pennant situation here. If it's even just the pennant, the symmetrical triangle, it's a continuation pattern, so I would expect it to break out to the upside. And I suspect, given the upgrade today, that would be what Morgan Stanley is thinking about as well. Moving to the downgrades very quickly here. AK Steel, Credit Suisse downgraded from outperform to underperform. They moved their price target from $3.50 down to $1. We are in a declining trend. Certainly we're testing the bottom. I drew that bottom in here. You could line it up here. It could have gone kind of a little bit higher, but I really wanted to magnify the fact that this was the low back in December, and we're testing it today, and it coincides with the bottom of a declining trend channel. If we do not bounce from here, that's it. I would look for that low that they're talking about. I mean, we could see it really take a dive. The PMO is certainly suggesting that. It's been oscillating beneath the zero line since April. So something definitely not a good place to be. I don't know, maybe a short position, but I'm more interested in buying. Let's see, Cloudera was downgraded today by Wells Fargo from outperform to market perform. Notice it did drop below its December low, so we got to go over to the weekly chart. Where's the next area of support? Well, we're setting new lows for Cloudera, so I wouldn't touch it. Who knows where it'll stop? We don't even know where a support level is at this point. Barrick Gold was downgraded today. I do see a falling wedge. Those are bullish patterns, and we can see the PMO is trying to turn up. Materials hasn't been the best place. Gold hasn't really been that great a place even, but I'm hoping to see that breakout. But I do see the 50 is below the 200-day EMA, just got a long-term trend model sell, so I wouldn't be too excited. That is all I have for the upgrades, downgrades. There you go. Tom talked about NTAP. Qualcomm ended up with 3 different downgrades today as well. So that's all I got. Julius, are you ready to go?
I am, actually. Let me grab the screen.
Let's break it down here with RRG.
Yeah. First, there's one thing I want to cover before we dive into the market stuff, and I think you'd be interested, Darren, because normally, that the third Thursday of the month is my day on Market Watchers Live, but the third Thursday was last Thursday. That was a week ago. And I couldn't do it because I was in London and I had some business meetings to attend. One of these meetings took me to a restaurant and for lunch, and we ordered a bottle of wine. And I was not involved in that because I don't have too much knowledge about wines other than whether I like it or not. But look at this bottle of wine that we got. And do you see the label on that bottle? So this is the enhancement. I mean, I had never seen that, but I think that we should make this the wine of choice for technicians. Doesn't matter whether you like Fibonacci or Elliott wave or whatever, but I think it just should be the wine of choice for technicians. I thought it was awesome.
Well, I'm ready to go try it with you. So.
Yeah, I had to share this. It was when that bottle came to the table, it was like, wow, that was no coincidence. Anyway,
Julius?
Yes.
You're a bigger geek than I thought you were.
That's why he and I get along so well.
We love having you on the show.
I mean, you can't make that up, can you? I mean, it's just impossible. Anyway, a little bit more serious. Yesterday, I wrote a blog about something that I observed because when I sit down to write a new blog, I do a lot of research. I go over a bunch of RRGs, and we have a bunch of RRGs, predefined groups on the RRG page on StockCharts.com. One of these groups is an RRG that is filled with international stock market indexes, and that's the one that you see here on this graph, and I have it highlighted here. The groups are, by the way, are here. When I went over it, I noticed that the S&P 500 is inside leading, and it's actually looking pretty good from an RRG point of view. It's actually looking pretty good. Just turned around, penetrated the leading quadrant, still at a strong RRG heading, but for some reason it didn't feel okay. It didn't feel like it didn't resonate with my view of the markets, and that has to do with my, let's say, longer term view of the U.S. market, and I base that off of the monthly chart of the S&P 500, and let me make that a live graph here, because what I'm looking at is this is the monthly bar chart, and we clearly failed at that previous high. I mean, the rhythm of higher lows is still intact, but we have a problem here in this 2900, 2950 area. And when I bring in I don't use a lot of indicators, but for, just price charts, I'd like to plot an RSI and a MACD, just, for trends and overbought, oversold, and divergences. And what I see here is a super strong negative divergence between the price chart and the monthly RSI. Now, I mean, if it's on a monthly RSI, I think it has an impact. It's a serious signal. Same for the MACD. I mean, the MACD rolled over on a monthly basis a couple of months ago, and it did not reverse back yet. You see that MACD line is still below the trigger, and the MACD line is already rolling back down. So that's still in a negative state. And then what I really don't like is that negative divergence on a monthly basis here, with that top failing. So this is my bigger picture for the U.S. market, and it just doesn't come across as super strong. And the problem is that the downside is still protected, but that trend line is around 2,400, and the upside is 2,950. So we got like 100 something points on the upside, but we got like couple of 300-400 points on the downside. So that's a risk reward that I really don't like. And that I had to match that with the fact that the S&P went into the leading quadrant. So I had to think about it. And what it actually is telling you is that the S&P is in a relative uptrend versus pretty much this whole list of international stock market indexes. And it's what I picked up from your talk earlier, Tom, that you said, the S&P is outperforming. It means that the US economy is stronger than the rest of the world, and that's exactly what it is. But what I wanted to know is, does that actually mean that the S&P is going to go higher? And if you work RRG on stock charts, you have an option to go back like 10 years. I mean, it's standard, it loads 1 year of data. But if you want to do some historical searching, you can actually go back 10 years of data. And if you really want it, you can actually animate it. I played it. Animating 10 years is going to take like a minute and a half, 2 minutes. So I'm not going to do that. But you can do that when you want it on your own system. But in the blog, I've highlighted a few snapshots where I noticed that when the S&P is moving into the leading quadrant, so either moving towards and into, very often it seems to concur with a high and or a decline in the market. So this is April 2010. You see that the S&P is moving inside that leading quadrant, well into it, moving to the right. It's right at the moment where the market starts to roll over. If we go to April 2011, it's at the top of the market, but you see that in the run up to that, the S&P outperformed. And it looks like as if it's weakening, but we all know that the strongest moves come when it rotates on the right-hand side of the graph, and that's exactly what happened during this decline. The S&P rotated all the way on the right-hand side. It never hit the lagging quadrant. So again, this is a situation where the market, and by the way, the market here is the Dow Jones Global Index. So that's the world stock market index. In 2014, again, we're running up to a high, and you see a rotation on the right-hand side of the S&P 500, the US market. If you go into June 2015, we are in a high situation, and we're rolling back up towards that. And we go into this big decline, the biggest decline that we had for a long time in this all the way up rally. January 2018 is where the market hits a high, and the S&P penetrated the leading quadrant and is still moving to the right, lost a little bit of momentum, still moving to the right. And at the moment, right now, we are with the S&P well into the leading quadrant. And are we making a new high in world markets? I don't know. We cannot really tell for sure. But with this knowledge and this observation, I'd like to be very careful with stock markets in general, and the S&P for that reason as well, because the S&P can be in the leading quadrant, but still going down. The only thing that this tells you is that the S&P will go down less than the rest of the market. So I tried to find a rationale for that, and my take is that investors, international investors, maybe see the US as a safe haven. So, when stock markets around the world are having a hard time, let's move to the US, let's move to US large caps, because they'll be doing pretty good. Just like you will see that during bull markets, small caps tend to outperform, they tend to do really well, and large caps tend to underperform. But when the general market starts to turn down, large caps start to improve and outperform small caps, because small caps are inherently more risky, so people move to large cap as some sort of a safe bet. So this is what I wanted to share with you from a let's say international perspective, and what it actually means when you see the S&P 500 moving into the leading quadrant, because it doesn't necessarily mean good news for the market as a whole. Now, when I wrote that piece yesterday, today on Thursdays I write the Don't Ignore This Chart blog, and one of the other tales that caught my attention was China, SSEC, the Shanghai stock market. It is on the RRG. Let me highlight it for you. In terms of RS ratio, the strongest country, strongest index on this universe. It's the highest in terms of relative strength ratio. So it's a very strong relative trend versus the global stock market. But we see this strong hook going down. Now the question is this the end of the uptrend, or will we see, and let me bring up that the ITC of today, because you see what I've cheekingly annotated that stock with a possible move, because we're in this very strong move. We moved into weakening, but we're very far away from the benchmark and from the 100 level. So there is a very good chance that we will see a rotation back up once this sort of correction is over. And the chart that I am looking at to back that up is this one here. And this is the SSEC index. And what I see here is this is what's caused that super strong move that we saw during the first, let's say, 5 months of this year. And we're coming off strongly off of these highs right now. And this is a 50% retracement level. Now, I don't use these retracement levels very often. I don't pay too much attention to them. But in this case, that 50% retracement level seems to coincide with two support levels that I'm watching. That's the 2800 level, which is a level that has been respected as a sort of area of shift in supply and demand a few times in the past. So that means something. That's around 2800, and around 2700, that's a little bit more pronounced and a little bit more recent. We see this as a support level here. We had this double bottom and that break. So with this move coming out of that downtrend, this is pretty much the first serious corrective move of this rally at this 50% retracement level and these two support levels. So I'd like to see this as some sort of a buying opportunity and a buying level in that 2800 area. Now, if we shift to that relative strength, we see that the downtrend in relative strength versus the S&P 500 has turned around, and it's starting to show this. It's still shallow, but series of higher lows, which is good. And if we translate that to the RRG lines, you see that during this whole downtrend here, the RRG lines have been camping pretty much below the 100 level with two small exceptions. It's now above it, seriously above it, and in its first corrective move. So if we can hold up, where is it? This rotation here, then China might actually be an opportunity going forward when that 2800 support level in the Chinese market index holds up. one thing I need to emphasize here, and I think is very important. It's maybe one of my things that I talk about too much and people get bored. But when people, and we can talk about that in the poll, because the poll is asking you whether you have interests outside of the US. Now, I know that a lot of people outside the US, or a lot of American investors, invest outside of the US via ETFs. But, and it's a good thing. I mean, that's absolutely the way to do it. When you do your analysis on these international markets, and you may have noticed that the RRG that I use and the charts that I use are using the actual indexes. So this is the index as it is traded in Shanghai. This is not an ETF. And the reason for that is that ETFs quoted in US dollars can look completely different from what's actually happening in that local market. Now, this is the Shanghai stock market, and here is the ETF of that Shanghai stock market. Now, let me put those side by side for you, and you can see what I mean. So here is that ETF, and here is that Shanghai market. So these are the same graphs. Look at that. This high in 2015 is way up there. Look where that ETF was. And look where that peak in 2018, which corresponds with this one, had a. So the ETF is way higher than the peak in 2015 than it was in the local market. The reason why that is because this one here, that's the S&P China ETF Spider, is quoted in US dollars. And the difference that you see is the exchange rate between the US dollar and the Chinese yuan or renminbi, to the Chinese currency. So for me, I'd like to do the analysis on the indexes. So I'd like to look at the chart of the Shanghai Composite Index. I like to look at the RRG that shows, you will see here, they're all dollar symbols, so they're all in their local currencies or their local index levels. And then when you start actually translating that into a position, then you move to some form of ETF or an instrument that is actually tradable for you, and that you can trade from your US brokerage account, et cetera, Just be aware that you are inheriting a currency risk when you do that. Okay, so from an international point of view, US market starts to outperform. I don't think that's particularly strong for markets in general. The Chinese market is way out to the right. It's the strongest market still in terms of relative strength, and it looks to be going through some sort of a corrective move and might offer new buying opportunities in coming weeks. So that's the take for the international markets. Let me get you the view of US sectors. Where did I stick that? So here is my RRG for US sectors. And I need to bring up my, go away, my dashboard and my chart list. And here is my weekly ETFs, and let's bring up the summary so we can have them side by side. Materials, symbol here. Inside lagging and at a weak RRG heading. If we translate that to the chart, I think that we clearly broke that support line, and what's even more important is we broke below this uptrend line, and we're already below this previous low. You see that the RS ratio line rolled over below 100. For me, this one looks ready to go lower on a relative basis, and there is plenty of downside on the price chart to accommodate that relative weakness. So this one is in my weak bucket. This is an underperform. I'd like to stay away from this from an absolute point of view. If we go to communications, that is a completely different story. It's almost moving in the opposite direction. It's inside leading. It's at a strong RRG heading. still moving there higher in that leading quadrant. If we look at the price chart, we see it failing at that 51 resistance area, that previous high that was set in the middle of 2018. But we are sort of breaking out of this range on the relative strength line. The RRG lines are moving higher in tandem at the same rate, so that causes that strong RRG heading. So, XLC Communication Services is one of the sectors that I think that, especially from a relative point of view, will have some sort of positiveness in store for us in coming weeks, even despite the fact that the price might go a little bit lower. Energy, very, very weak. If you see how that rotated, you see that was improving, but before it was even close to getting into the leading quadrant, it already started to roll over, and it's now on a track almost vertically down and inside the lagging quadrant. That's what we know is a very weak rotation. And if we put that on the price chart, you see that we have some sort of a similar situation where we broke the uptrend, tested the old support line as resistance, and we're now heavily moving down. And today is again a weak day for the energy sector, and we broke below this previous low in relative strength. RS ratio is rolling over way below 100, so that's one for the negative side of the RRG. That's an underperformer. For the financials, different story, moving from leading into improving. Question is, how sustainable is that move? You see that it has a short tail, so there is not a lot of power behind that move, and the move is pretty much only vertical. It's only gaining on that RS momentum scale, and it's not picking up a lot of relative strength. And if we study that on the price chart, we see that series of lower highs and lower lows on the relative line is still there. It's still, comfortably below the 100 level in terms of RS ratio. That's what you can see here. I don't think that it'll be able to push beyond this resistance or relative strength. And if you look at the price chart, it just touched that falling resistance line, and it looks as if it's completing this rising wedge pattern, which is not a very good sign. So energy remains, financials remain on the weak side of the spectrum as well. This is not a sector that I expect to outperforming going forward. Industrials, inside weakening, but very close to crossing over into the lagging quadrant, and I can see that happening with this big wedge being executed on the price chart. A triple top or 3 tries to break above that level didn't work. 72 provides some sort of a support, but more importantly, this support and relative strength seems to be breaking. There's a little bit of room left before we hit this previous low in relative strength, but those lines are rolling over. And this one is so close to that 100 level on the RS ratio that I expect further weakness going ahead and more underperformance for the industrials sector. Technology, we all love technology, or maybe I should say we all loved technology, because it's rolling over. It's the strongest in terms of relative strength, but it's now losing momentum. So the question is, how strong is this loss of momentum going to be, and how far is it going to set us back? It's a little bit like the Chinese rotation on the international RRG that we just saw. What I don't like is that we broke above this previous high and are now breaking back below it. That's usually not a very strong sign. And it looks as if the same thing is happening with that break in relative strength that's now breaking back below. I am not a buyer of technology at this point in time. I'd be very careful, but it's too early to call it a strong underperformer yet. But I'd be very, very careful and maybe look to unload some of the technology holdings in my portfolio because of this rotation. So it's in the neutral camp, so to say, neutral to weak. Staples, I do like staples. Why? Because it's rotating strongly. It's got a strong RRG heading. It's in improving. close enough to the leading quadrant to be able to pull through and continue into the leading quadrant. But really, because it just broke to new highs and it is still holding up above those previous highs that are now acting as support. So here we have a sector that is well protected on the downside, has got a ton of upside potential in terms of price. And you see that this longer term falling trend line, downtrend in relative strength, is turning around. We see the first higher low coming in. If this continues and those RRG lines will push above 100, there is a bright future for the staples sector. And as we all know, and what Tom pointed out in his part, is that when staples are doing well, that's usually not the best thing for the market. Real estate, interest rate yield sensitive, looking pretty good. We see a rotation, a curling up inside the weakening quadrant, starting to move higher, picking up rotation there. So that's good. And if we can push above this previous high, supported by a break above previous highs in relative strength, this could actually be one of your stronger sectors going forward. So keep an eye on this one as a safe haven or an outperformer. Utilities, traditionally a defensive sector, not yet visible on the RRG, although it is inside lagging, but starting to pick up quite rapidly right now. And what I do like is the fact that it seems to be breaking out of this flag pattern on the price chart. It's confirming its uptrend. It's at new highs, which is very strong, just like staples. So you got utilities and staples breaking to new highs. And it looks as if the breakout that we saw in Q3 in 2018 is holding up, and we're now ready to move to new relative highs with that rotation pushing higher. It's a little bit early here. It's a little bit early for utilities. Staples are further down the line, and so is real estate. But this one is definitely one to keep an eye on, especially in the back of our minds, the expected weakness, or at least my expected weakness, for the US market as a whole. Then usually utilities will start to shine, and they're ready to rotate back up. 2 more to go, and then I think I'm doing pretty good on time here. This is healthcare. I don't know what's happening there, but this one is very, very weak over the last 8-9 months out of this high. It was super strong in 2018, and then it started to deteriorate, and we see a little bounce here, and it looks impressive, but if you look at the RRG, it's still losing. It's still moving to the left on the RS ratio scale. It's just picking up a little bit of momentum. I mean, as the song goes, that don't impress me much. It is, from a relative point of view, it's the weakest sector in the market. From a price point of view, it's inside a consolidation pattern. Maybe you want to call it a triangle. I think it's way too big for a triangle, but it's, the highs are getting lower, the lows are getting higher. It's going into that cone, sideways at best. I'd be very, very, we've got way more up. The way I look at this stuff is, I'm not going to make up my mind whether it's going to go up or down, because we've got enough areas of the market and enough stocks in the market to go if we don't know what's happening. And this is typically one of these sectors that, it looks very weak to me. Could go either way. I'd like to look for opportunities elsewhere. Just stay away from that healthcare sector. And then finally, we got discretionary, which is the opposite of staples, almost, but they're still moving in the same direction. What I see here, this was and still is probably a strong sector in terms of relative strength, because we are at a high reading. But what you see here, it's got a very short tail, and what you see is that those weekly observations over the last 5 weeks are getting closer to each other. And I've discussed this previously here on Market Watchers Live, that when these distances are getting closer together, the odds for a rotation are getting bigger, because it's easier for that tail to roll over. And that's what seems to be happening right here. Look at that price chart. We broke to new highs, broke back below that support level. This resistance level should act as support. It didn't do that, so it rejected that support level, and that's usually not a good sign. So everybody who bought on this breakout is now probably looking to get out, which is not a good thing. And the same thing goes for that relative strength breakout. That's not holding up. And with this rotation here, it's not a super sell for me, but it is definitely a sign that weakening is ongoing. And I'd like to see a new higher low to get back into place before getting very enthusiastic about this discretionary sector going forward. Summing this all up, it means that I got, on the positive side, I got communication services, staples, and real estate, with utilities neutral to positive. And then I've got very weak sectors in materials, energy, financials, industrials, discretionary sort of rolling over, technology, at least temporarily rolling over, and healthcare seem to have had his run, but very, very uncertain. So all in all, not too strong about the market in general, and from a sector point of view, more gearing towards a defensive holdings in my portfolio. That's about it, Tom.
Yeah, well, I would agree. I think right now, especially with the market weakening, and in the short term anyway, we're seeing some technical failures where we're coming up, failing to get through some key moving averages, rolling back over, testing some prior lows. Got the 10-year Treasury yield breaking down today, as we talked about earlier. So there's definitely reasons to be somewhat defensive out there right now, even whether you're looking short term or intermediate term. So I agree, and I thought that your discussion of the consumer staples area being strong was right on spot. That's what I'm seeing as well. I see a lot of the staple stocks doing extremely well, with at least on a relative basis.
What's your take on the ratio? I mean, I know that you look at that staples discretionary ratio a lot as well, but that's not giving a real clear signal right now, is it?
No, it's not. I mean, I look at it from a much longer term perspective. I try not to look at it on a day-to-day basis or even week to week. I mean, it's more, months to years. It's more of a big picture kind of a thing that I look at when I look at the XLY versus the XLP. Anytime the market weakens, and we've been seeing that over the past few weeks, anytime the market weakens, that XLY, XLP ratio tends to move lower. So I don't get too concerned about that. What bothers me is when the market begins moving higher, and this ratio, the XLY, XLP, goes down, because what that's telling me is that in a rising market, the consumer discretionary area, which is much more aggressive, is not leading to the upside among consumer stocks. And that can be a warning sign, a major warning sign in the market. So what I'm seeing over the last few weeks, obviously I don't like to see the market go down. I'd much rather see the market go up every day, but it's not making me think that we're going to have a long drawn out sell-off over the summer. I don't believe that, but we'll see. All right. I know that we do have a poll, though, because you mentioned that earlier, Julius, that we want to get an idea of what everyone is doing out there in terms of.
Let me see if I.
Here we go. We got it.
There it is.
So
41.
What are your initial thoughts when you look at this?
My thought is that a lot of people think that the U.S. is big enough to invest.
Yeah.
So not a lot of people, very few people in Oceania. I wonder if they know what Oceania is.
I did not. I'll admit it. When you said that, I was like, okay, I don't know what that is.
That was funny.
I'm going to Google it after the show.
Yeah. No, I mean, in a way, I can get it. I mean, I look at the U.S. as a region. I mean, for me, I always have a U.S. dollar risk when I do anything in the U.S. So for me, Europe is home. The euro is home. That's my local currency. But if you're in the U.S., and let's be honest. Or I have to be honest. The U.S. is big enough to get a lot of diversification. When I wasn't too much involved with U.S. companies like I am now with StockCharts and a few others, so let's say earlier on in my career, I always thought that U.S. or Americans were pretty narrow-minded because they stuck to the U.S. and I'd like to joke always that the world stops when you hit the water. But I learned, and I had to adjust my opinion. In a way, it does. The U.S. is so big, and it's giving you've got so many opportunities to to invest and to get a good diversification in your portfolio. If you don't want to, you really don't need to. I mean, maybe if you're a super huge institutional investor with a ton of money, then you might have to be forced to look overseas. If you are a very advanced private investor, you may want to look for some opportunities outside. But if you want to keep it simple, the US is probably big enough to run a very, very decent diversified portfolio. So I thought that poll was fun, but I can totally understand when people are not looking outside the US. Yeah. Quite interesting to see that emerging markets are very popular.
Yeah, I just want to add one thing before we move on to the 10 and 10, because I think this is really important, and a lot of folks who invest in ETFs probably have no idea. But this is a quick chart. Dollar going back the last 20 years. This is a monthly chart, so you can see the dollar was going down for a while. Now it's going up. I looked at the DAX, the German DAX, and compared it to the EWG, which is the iShares for Germany. And in essence, they should go hand in hand. And when you look at the charts of the two, you say, well, they're going exactly together. But the rate that they move up or down is not the same. And so what I wanted to just point out is when we're in a falling dollar environment, like we were in 2001 to 2008, the EWG, these iShares, will outperform their underlying index. And when the dollar is in a rising environment, they will underperform. So if you're looking at the DAX and you see the DAX is up 20%, well, it hasn't been up 20%, but if it's up a certain percentage over a period of time, and you look at the EWG and you're like, why is mine only, why am I 5 or 7% percentage points below the index that I'm following? It's because of the dollar. There is a dollar component in these various ETFs that track foreign markets, and you need to be aware of that, because many times, especially if we get in a real strong dollar environment like we have been in, you can see some very significant erosion because of the dollar.
Yeah, you're nailing it, brother. That's exactly what I just tried to explain with the Chinese market. Yep. If you invest in China through an ETFs, it's a good thing. ETFs are great tools, but please be aware of the currency effect that you're inheriting by buying that ETF, and do the analysis on the actual index and not on the ETF, because the ETF is simply the result of the index price multiplied by the dollar rate. It's not what people are actually trading.
Yep, completely agree. So I think hopefully we've driven that point home. But I agree. I think 41% on that poll said that that they don't invest outside the U.S. I found that to be a little high, but I don't know. We shall see. But anyway, it's time to get into the 10 and 10. I know we got still a lot to get through, so I'm going to go ahead and just start it off here with the first stock, which is Halliburton. I don't like the stock. You can see the big breakdown here, heavy volume coming in, and just look at these relative charts. There's just nothing to like here. Invest in these energy companies when the dollar's falling and when they start to show some relative outperformance. Until then, I would stay away from just about all of them.
All right. Wow. Okay. Okay. The next one is the most popular in the chat room, and that would be Square.
Yeah, Square is in a great area, but it's just not a good performer. And so we need that relative strength to pick up. If I was going to invest in the space, I'll tell you, it's going to be probably PayPal or Global Payments, maybe a couple of others. EVRI is a smaller company that also, has been doing very well on a relative basis. But you can see Square breaking down, but the overall group has been going higher. So your relative strength, which is so important to keep an eye on, if you're trying to outperform benchmarks or you're trying to outperform your peer groups or whatever, you want to be in the strongest stock. So the group has been great on a relative basis. Square is just not the right place to be. I would pass.
All right. Next one up is Income Services, J2 Global, JCOM is the symbol.
Yeah, this has been a pretty good stock in a good space. I think for the most part, we are traveling in the right direction on these relative charts. So I think we're just consolidating. So when we have a day like today, I think it presents some opportunities on the long side. It's certainly improving the reward to risk ratio. I will point out, though, that the volume did come in on this last move to the downside. So you really want this area to hold. I'm going to say any kind of a close below 82, 82.5 would have me very nervous with the stock. But the closer we get down to 83, I think the reward to risk is stronger. So I think it looks good on a relative basis. I wouldn't have a problem getting in on a little bit further pullback, but I would have a tight stop.
All right. This one has been a popular request, I think, every day. So we're going to take a look at it. Aerojet Rocketdyne, AJRD.
Well, it is in the aerospace area, and it has been performing pretty well. You can see down here, or excuse me, it's in defense. You can see down here the defense group relative to the S&P 500. I've talked about this quite a bit recently, has broken out to about a 6-7 month high. Aerojet versus defense looks like it's starting to move higher, although I'd like to see another relative breakout. But in the meantime, look at where it was holding on support. Anytime you get a big gap up and a hollow candle on heavy volume like we had right here to open May, look at when we came down, we hit the 20-day moving average in the top of gap support. 5 or 6 days later, we were right back to the top of this range. So when I short-term trade, that's the kind of trade that I look for. Unfortunately, I didn't have this one. And I think we do need to watch this short-term trading range. But what you want to see if you own it is an absolute breakout there and a relative breakout down here. I like the space. I do like defense.
All right. Excellent. Next one up is biotelemetry, BEAT, sitting on really important support right now.
Yeah, I mean, it's been downtrending below the 20-day. I mean, the medical equipment group's been bad, but it hadn't been this bad that you see here with BEAT. So I don't like the relative weakness, so I wouldn't be in. But yeah, I agree. I think, getting back down close to these lows. I mean, there was a low right there, right before we had the gap up back in July. We had some support around 47, same thing in October, and here we are. So I do agree with you. I think this is a major support level, but my strategy is not to place support on stocks that are underperforming because I'm really afraid they're going to go even further south. I would just say this, because it is an underperformer and a very strong underperformer on a relative basis to its group and to the S&P 500, I would have little patience. So if it doesn't hold 47, I'd be out.
All right. Let's see. Next one is a special consumer services industry, PetQ. PetIQ.
All right, PetQ. Yeah, the relative strength not good with an overall group that has been very strong. So I just think you're going to find better stocks in this group elsewhere. So personally, I wouldn't get in. Now, maybe if we can get through, we got obvious overhead resistance at 32. Recent lows have been holding down here at about 25. We're in the middle of this trading range in a stock that's been lagging. I don't see a trade here, so I would pass on it.
Okay, let's see. Next one up is QRVO, Corvo.
Yeah, this one's been getting hit really hard with everything going on over in China, the trade war, the Huawei, all the issues associated with that Chinese technology company. So I think this one is just one of those. I don't know how far this is going to go down, but it broke down. It broke its uptrend. It's underperforming a very, very weak semiconductor group, breaking to 52-week lows. We're going to talk a little bit about this maybe if we have enough time at the end, looking at the semiconductor group. But this is one that just is not very strong. I mean, if I was going to do something with semiconductors, I think it would have to be with something like AMD, which has been holding up much better. But, you can just, it doesn't take a whole lot. You don't need a PhD to see that the stock is just not being bought. Wall Street's turned its nose up to it, and I would too. Going to pass.
All right. Let's see. Next one up, Harsco Corp, HSC.
All right, Harsco. Like the breakout, this one's coming back down close to an area that I would consider entry. Here is a group that started to turn lower, so relative strength isn't great, but it's been a great relative performer. So you're in a bad group, but you're in a good stock. So I like that huge gap up, and I think your best support is going to be right in here on this massive volume day. Opened at 24, went down to about 23.5, and that's where the buyers came back in, sent it to 27 the next day on very heavy volume. I think as you work your way back down closer to 24, and maybe even at the 20-day moving average, I think that down to 23.5, this dollar area is where I would be interested in buying. If I was looking for entry, I'd be using a target at 27, and because the group has not been a great area, I would probably have a pretty tight stop. Certainly at close below 23.5 would have me out.
All right. This one's getting hit hard today. Ulta.
Yeah, I think it's just getting hit hard because the overall the overall market's getting hit. This has actually been a very, very strong performer, one of the best in the specialty retail space. So this is likely going to result in another opportunity on the long side. But yes, it is getting hit hard, and I see it probably going back down to test this 328, 330 level, especially if the market stays weak. So there might be some other better stocks out there, but this is not a bad one in this space. So if the rising tide lifts all boats, then I guess the lowering tide lowers them, because I think that's why Alta's going down here.
All right. Another one getting hit really hard today is Splunk. SPLK.
Yeah, and I think this is the last one, right?
Yep, it is the last one.
Okay, Splunk, they report earnings after the bell. So the stock's getting hit, but who knows what's going to happen after the bell. It's in the software space. So if there's if there's a stock that could come through here in this kind of an environment, it might be a software stock. Now, Splunk has been going lower versus software for the past few months. So I wouldn't take a chance into its earnings report. But I think if I was annotating here, I would just try to keep an eye on two levels. The recent high with the gap up on earnings there and these recent lows. It's a wide trading range. I think we could be at either end of it when they report their earnings this afternoon. So I would pass on holding into earnings.
All right. That does complete the 10 and 10. Here are the symbols we just went over. I will have these up in the Market Watchers live chart list right after the show. Just go to the articles tab, click on the Market Watchers live blog, and the link to the live chart list is right there at the top. Well, Tom, you use price relative charts all the time, and we have Julius here who uses the RRG, but a lot of people may not be familiar with market carpets. So today's Talking Technically is about market carpets with John Murphy.
I'd like to explain to you today how I use the market carpet section of stock charts, not so much to find out which sectors are strong and which sectors are weak on any given day, but to try to dig down a little deeper and find out which stocks are actually driving those moves. So if you go to the screen here, this is the market carpet of the S&P sector ETFs that you will find on stock charts on the market carpets page. And you'll see the different colors here, the 11 boxes. These are the 11 sectors, of course. And you can see right off the bat, the ones that are red, for example, energy right here and healthcare here, those are the weakest sectors of the day. The strongest sector of the day happens to be utilities. It's the only one in the green. So we're having a slight down day in the market. Market has a slightly defensive tone. And if you look over here, you'll see utilities, materials, cyclicals, real estate, and communication stocks. Even though they're down on the day a little bit, they're actually doing better than the rest of the market. So I want to just zero in on one of them, and I'm going to pick the communication services right here. And if you click on that, that takes us right to the individual stocks that are in the communications ETF. And what I've done here, by the way, you'll notice there are different sizes. So you can actually click on this and look at it in market capitalization mode, which means that the bigger box are the biggest stocks in the index. Google, for example, is one of the biggest. Facebook is another one of the biggest. Also, Disney and Netflix are quite big. But by glancing over here to the right, it tells me which stocks are actually leading this particular sector higher today. Dish Network, Activision, Netflix, Disney, and Facebook. I'm going to take a look at the two in the middle today and see what they look like. Not only are they leading this ETF higher, but they also are among the biggest stocks. And by simply clicking on that and clicking on this, you can actually see the chart of Netflix. It always ends by looking at the chart. I mean, we can look at what's leading and what's lagging, but we still have to look at the chart. And the chart looks very good. It shows the stock of Netflix. This is a daily bar chart moving up very nicely over the last couple of months. Notice that it's trading well above its 50-day moving average. So this is a stock, if you're looking to buy a stock in the communications sector, this is certainly one stock that you might want to look at. The other one is Disney, chart of Disney, and it looks very much the same, symbol DIS. You can see that this stock Also bottomed over here. It's been rallying very nicely. It has moved above its 50 and 200-day moving average and is moving higher. So by using the market carpets, it's just a shortcut way of looking at the sectors first of all, seeing what sectors are leading on the upside, which ones are lagging on the downside. I tend to look for the leaders, of course. Then you simply click on the sector you want to look at. It then shows you the individual stocks within that sector. I tend to go for the bigger stocks because they have the most impact, and the ones with the green. And by clicking on those, sometimes you click on 4 or 5 charts, you might find 1 or 2 in there that look very promising. Today they happen to be Disney and Netflix. Tomorrow it may be something else. But it's a very, very simple way to drill down and find out what stocks are leading the markets in the strongest sectors.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
All right, it is time for our final market update. Let's see what's been going on here. Dow is continuing its way lower, currently down 1.61%. S&P 500 is down 1.59%. NASDAQ is getting hit particularly hard. It is down almost 1.9%. NYSE also following suit, down 1.45%. Russell 2000 definitely getting hit the hardest of our major indexes here. It is down 1.95% currently. TSX Canadian markets also following the markets lower, but it does appear to be consolidating, whereas our markets do seem to be continuing to make intraday lows. TNX continues to fall lower, reading 2.306%. VIX is rising. We were sitting right around the 15 range yesterday and the day before, and now we're starting to poke up here above 18 for the VIX. UUP, quite a roller coaster today. Big move to the upside, but has just fallen very, very fast. It is down 6 cents, reading 26.33. Gold having a good day, but it has been up all day long. It did not matter that the dollar opened much higher. It did gap up. Looks like it's forming an intraday flag. USO is falling, sitting right at $12 currently. TLT gap up and moving higher. Looking at our sector summary right now, the leader is utilities. Every other sector is in negative territory, with energy getting hit the hardest, down 3 3/4%. That's all I have for my portion of the market update. What do you have, Tom?
All right. I just want to point out the Russell 2000 because I think this is a really interesting area where it is right now. You can see at 1500. This is where we bottomed when the volatility spiked back at the end of March. So I think this is a key support level technically. Seasonality, I've pointed this out before. June is the best month of the year, Russell 2000 versus the S&P 500. And that outperformance actually begins on May 26th and runs throughout June. So next 5 weeks, starting on Monday, Tuesday, we do tend to see the Russell 2000 outperform. That's an average return over and above the S&P 500. That's not saying that the Russell average is going up 1.6. It says that's saying that the average outperformance of the Russell versus the S&P 500 over the last 20 years is 1.6% during June. And I bring this up because look at the relative support line that the Russell is at right now versus the S&P. So I'm using this as a possible entry into the IWM later, either today or tomorrow. If we get a reversal on the market, especially on the Russell 2000, I think this would be a very interesting area. Just wanted to point it out. Okay, we're going to go into our final segment, the dead zone. And just to give you, because this is a new segment, we're just going to take a look at some of the areas that have been getting hit the hardest here over the last month. They truly have been the dead zone. And I think it'd be a great opportunity with Julius on board with us today. He always so graciously accepts our offer to stay with us through the end of the show. And so, Julius, looking at this group, and I know you have a number of stocks, individual stocks on this as well, but looking at the computer hardware, do you see any bright spots?
Yeah. Well, I've loaded up the number of stocks that you just sent me, and there's a little bit of a concentration out there. There's a few that stand out. If we really quickly go over it, USAT looks really, really strong. If I look at that little chart, it had a very quick run, but this might be one of the things that you want to look at. Another one is Cray, because it's rotating there, but I believe that something happened there because this is a gap that jumped from 30 to 36. So we're following that. Not sure about that. You might have another take on that. Apple is very close to the benchmark because it is the biggest one in there, but still it's on the positive side. DBD, big rotation, but far away on the right. And if I look at the chart, we're at support level. So this is one that you might be actually looking at because it could rotate back up. And then the other ones are sort of not very good.
Yeah, and actually, if you could do one more thing there, Julius, if you could get on the Apple, just click on Apple and then show everyone throughout the year. If you drag throughout the year to show Apple rotation, because basically Apple is the computer hardware index. That's what I just wanted to show that if you're comparing Apple to its benchmark, it's really not going to move much throughout the year. So that one's not going to stand out, obviously, because it essentially is the index. But the others you can see rotating around it. Just wanted to point that out.
Yeah, so, absolutely, you're right.
Yeah, looking at some of the individual charts, Erin, anything that you see in that area?
In the technology space?
Oh, actually, never mind. I know I was going to have you do the retail. Let me go ahead and take a look at a couple of these, because when I was looking at these stocks, I actually thought that MRCY looked pretty good. So I'm going to pull this chart up for you and take a look. All right, so MRCY, and I talked about this one the other day. This is the stock that came out with a common stock offering of roughly $350 million, which was about 10% of the market cap. So dilution is always an impact, and you can see the stock moving down there as a result, but it's still holding up much better than the overall computer hardware group. So if I'm just looking at the computer hardware, you see how much further we're down, and the 20 now is below the 50 and so forth. Well, if you look at that MRCY chart, this is just about the area where we got this nice breakout above 67.5, and we're down near the 50-day moving average, also close to recent support. So I actually think MRCY is one that you might keep an eye on. If the group were to turn back up, I think that's one that could be a really strong performer. And then I think also, and I didn't put this one out there as one of the stocks to look at, I should have, but Roku is in that space, and Roku has been a tremendous performer. Rather than an Apple, I think Roku might actually look pretty good in your portfolio. But anyhow, let's move on now, Julius. I'm going to turn it back to you for apparel retail, and then Erin will come back in and take a look at some of those stocks.
Okay. You're muted there, Julius.
Yeah, no. I'm back. I'm a guy. Multitasking is super difficult for me. So, here you go. This is the apparel retailers, and I quickly went over all these, and as you can see, these are pretty good, but losing strength. Boot is rapidly losing strength. In this whole group, the one I think I like most is ROST, Ross Stores. So if I go to the other ones real quickly, then they're all in lagging, and you can see these headings are very weak. They're losing stuff all the time. So this rotation of ROST, inside weakening, but back up with increasing strength between the observations is something that I like. So yeah, that'll be one for me.
How about if you looked at it from a daily perspective instead of weekly? Would that change your mind on any of these, Julius?
Let me see. I can really quickly do that. What do we got here? ROST. Oh, and then boot shows up. as
Right.
potentially interesting. So yeah, boot could be from a daily perspective. ROST is a double whammy, weekly and daily. And GCO, it's already starting to move lower, so it's strong in relative trend. But the danger is when they're too far to the right that you're chasing the move, and you really want to be looking at something that's just coming in there or still heading in a positive RRG heading. The other ones are still not very good.
Yeah. Okay. Erin, do you have any favorites there?
Yeah, and it's interesting. I always know that the analysis I do is very similar to the RRG analysis in that a lot of times they do come out kind of the same. And the first one, here's the candle glance, because everybody knows I love to use my candle glance to look at all of them at once. By just looking at the PMOs, the only one that looks even really interesting to me is, of course, Boot Barn. And you were just talking about Boot. So I'm going to pull that one up first. And, I'm looking at this double bottom. It just is coming over that confirmation line out of this decline into that double bottom. It's hit the $31 though area of overhead resistance, and it is pulling back somewhat. But I like the way the PMO is reacting. I think the OBV is making a nice move to the upside. I guess one thing I'd be a little concerned about is the way the volume has been sort of petering out here on this really nice rally. So that might give me a little bit of concern. But of the dogs of this group, I would have to go with Boot Barn. But the other one that looks somewhat interesting to me was Ross Stores. Mainly, these are the ones that just I wouldn't touch with a 10-foot pole. Abercrombie, look at these PMOs. They're just ugly, ugly, ugly. The only one that I thought had some possibility of maybe turning itself around might be Ross Stores and might be Genesco, but I like the setup of price on Ross Stores because it is testing that support level at about $93. Yes, we did get that drop below the top below the signal line on the PMO. I mean, this would not be my first choice of any kind of investment, but if you're going to ask me to pin it down to which ones I think are the strongest of the weakest, I would go with Boot Barn as my first, and I would even consider that one as a possibility. And Ross Stores would be number 2 for me.
Yeah,
so we're about right.
Volume there on Ross Stores I think looks really interesting. Stock's
Yes.
down and the on-balance volume keeps going up.
Yes, and that can be a good thing, but it can also be a bad thing because if you think about it, the OBV, of course, calculates the volume that comes in. On an up day, it goes up, and on a down day, it takes that volume and subtracts it. So this is a reverse divergence. So it could actually be a bad thing. When you see volume and positive volume coming in and the OBV is rising, and that cannot push price higher, to me, that could be a little bit of a warning sign. But if you're looking at it the other way around, of course, you've got rising bottoms here coming in through here, and you do have a decline of the bottoms right through here. So, I mean, you could look at that part of it as a positive in terms of maybe we'll get that bounce. But in a longer term picture, I don't like to see that on the as far as OBV tops being higher and price tops moving lower. So, all
right, if you could pull up ANF, because I know you said you didn't like that. This is maybe will contrast our styles because this is the one that I would have picked, and because it gapped up on that huge volume back in early March.
Mm-hmm.
That gap up, that's earnings related, and we are just now getting back to the top of that gap support, which I really like. So I don't like the group. And I'd keep a tight stop if it doesn't hold that. But I actually give this one, I think your PMO too, coming down to that center line support area. This could be an area where it does begin to turn. And I know that
I would hope so.
Yeah, one of the differences between the way you look at a stock and the way I look at it, especially for anybody who's new, is a lot of times I'll try to anticipate a turn in momentum at a key support or gap area. And I know the PMO is not going to react until it actually makes that turn.
Right.
So that would be
suits my intermediate term investing style. I don't want to take the risk in the short term for something in the intermediate term.
Right. Okay. One last one, and we're going to try and go through this one pretty quick, Julius. But if you would like to pull up the semiconductors, another area that has been just trounced in the
There
past.
you go. Here it is. Really quickly. MRVL, AMD, and BRKS would be my picks. NVDA inside leading, but rapidly coming down from very high momentum levels, so that's usually not a very strong sign. Those three, BRKS, AMD, Marvel, they're pretty good. The rest is all heading really, in a negative direction.
Okay, and I'll just add there, those are three of the highest scooter ranked semiconductors that you just talked about. So another way of looking at relative strength is comparing scooter rankings, and those three you mentioned were all among the highest. Erin, did you have any here on semiconductors? Did you like any?
Yeah, if you don't mind, I'll just take the screen for 2 seconds here. Well, a little longer than 2 seconds, but here was my candle glance. I think Intel looks okay. We're at that very important support. I think the PMO is turning around, and Infinera looks pretty good to me. It's coming down the bottom of that trading range. Could end up being an island. AMD, I mean, it's held up. I mean, look at how everything else has been going, and it's been managing to hold up. So despite the PMO still in decline, I would have to say I think AMD looks pretty good too. Marvel, it's trying to hold support at 22, but I don't know.
And I think too, one of the ways, just a quick glance, when you look at these PMOs of yours, if it's above the zero line, they still have some positive momentum. I think the one
Absolutely.
one's below that center line.
You don't have BRKS in there.
Oh, I missed that one?
I guess.
Oh my goodness. Well, I'll show everybody how you can very quickly do that.
Great.
BRKS. And there it is. Add it. I'll go back to my candle glance there. BRKS, there it is. Just got that sell signal, but it is, it's got a PMO rank of 5. And a lot of people don't know it, and I don't talk about it a lot, but you can use the PMO values to give you a relative strength ranking. So of all of these, certainly BRKS has the best PMO value, followed by AMD and LRCX.
Yeah, that BRKS also sitting at that gap support area. Right.
I was just going to say, Tom must like this.
I like it.
There it is.
Yeah, but again, because it's in such a weak area, I wouldn't have any patience with these stocks. If you're in a weak part of the market, what that is essentially saying is that money is rotating away from the group. If the money's rotating away from the group, even if you're one of the strongest stocks, you can get hit simply by that rotation. So I like BRKS, and especially I think if semiconductors were to bounce and start to make a run, I think BRKS would be one of the first to get money back into it, along with AMD. I agree with both of those.
All right.
All right. Well, it is about time to wrap things up. Here is our summary for this event. You can see a number of the individual stocks that we talked about in these 3 areas. Julius, I want to thank you. Always a pleasure to have you on here. Love the fact that you stay with us through the end of the show. You give a lot
My pleasure.
Great insight into the RRGs.
Yeah, in fact, Tom and I said as we were prepping for the show, Tom says, "Oh, we have Julius on today. It's going to be fun." And that's how we both feel.
And then he brings up a wine picture.
That's all right. I wine on here every day. Different kind of wine, that's all. Anyhow, it is good to have you. So what do you think? We got about 10 seconds. I mean, are you afraid of the market here?
Yes.
Okay. Be cautious. I think that's probably the word. I will say, historically, from a seasonal perspective, the end of May into June is a very, very bullish time of the year. We'll see whether or not that comes through this time. All right. I want to thank everybody for being with us today. Special shout out there to Julius for sticking around. Please remember to complete the survey as you exit. It's located below your video player. We would love to get your feedback, hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody, and we will see you back here tomorrow. Happy trading.